The U.S. Federal Reserve on Wednesday announced a hold on its benchmark interest rate in the 4.25 to 4.5% range, where it has been since December. This is as it continues its wait-and-see approach while digesting the impact of the Trump administration's economic policies. Fed Chair Jerome Powell said at the press conference that the Apex Bank was still well positioned to wait to learn more about the course of the economy, adding that the economy and jobs market were healthy enough. The central bank also expects higher inflation, a slight dip in gross domestic product, that's economic growth, but still foresees 2 interest rate cuts by the end of this year, the same as it projected in March. Powell seemed to be still signaling we really don't know what will happen. Too many unknowns. Too much remains unclear. But these are thoughts for now, urging much closer attention to future inflation, jobs and economic activity data and less reliance on forecasts and plots that will most likely change. Markets not as convinced or not listening, as the Dow immediately took a dip into slightly negative territory after the conference, paying little attention to the cloud of uncertainty over narratives, forecasts, projections and plots. Hello, welcome back to Global Business Insights, where we take a closer look at the main business headlines moving markets all over the world. Today we look at the Iran-Israel crisis and 2 major apex banks' decisions to hold rates unchanged. That is the U.S. Federal Reserve, that's the Federal Open Market Committee, and the Bank of England's Monetary Policy Committee, as we see global uncertainty putting the major banks in a tight spot. The Federal Reserve trimmed its outlook for the U.S. economy, saying higher risks of inflation. GDP growth at 1.4% for 2025 is substantially weaker than 1.7% forecasted in March. Unemployment also seen as rising from its current level of 4.2% to 4.5%, higher than the 4.4% March summary of economic projection forecast, and personal consumption expenditures inflation increasing from an April figure of 2.1% to 3%. 7 rate setters expected the federal fund's target range to remain unchanged in 2025 compared to just 4 in March. Quite a hawkish slant. But 8 members still see 2 quarter points, that's rate cuts this year. Let's listen to a clip of what Powell said.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor.
Now to the UK. At the meeting ending on 18th June 2025, the Bank of England Monetary Policy Committee agreed by a majority of 6-3 to maintain bank rates at 4.25%. That's the benchmark rate. 3 members voted to reduce the benchmark rate by 0.25 percentage points to 4%. The pound sterling pulled back slightly as markets digested the Bank of England hold, which did not come as a surprise. According to the statement released, year-on-year UK inflation was up 3.4% in May from 2.6% in March, mainly due to a range of regulated prices and previous increases in energy prices. The CPI should stay at the current rates throughout the remainder of the year before falling back towards the target next year. Also, the committee remains sensitive to heightened unpredictability in the economic and geopolitical environment, adding that a careful approach to the further withdrawal of monetary policy restraint remains appropriate. Analysts were not expecting a cut until August, even before fresh conflicts in the Middle East potentially begins to stoke inflation, as crude oil prices initially jumped 8.5%, further reducing chances of a Bank of England cut. But also, UK inflation remains uncomfortably high, although there has been substantial disinflation over the last 2 years as the restrictive stance of the Bank of England curbed price increases and stabilized long-term inflation expectations. Underlying UK GDP growth remains weak, and the labour market has been less tight, with measures of pay growth moderating. There is a difference between the context faced by the UK compared to the US. In the US, the data so far for inflation is lower, but uncertainty around policy shifts on trade, taxes, and immigration have forced the Fed to wait since December. And in the UK, the hold is more driven by an already anticipated need to be cautious, recently worsened by geopolitical developments. The UK is more vulnerable to the geopolitics, being more dependent on imported energy. The Swiss and Norwegian central banks, however, became the latest European rate setters to ease monetary policy. That was also yesterday, citing a weaker inflation outlook as inflation slowed to 2.8% in May. That's Swiss inflation. Sweden's central bank, which cut its key interest rate to 2% from 2.25%, also cited easing price pressures and slow growth. The other big story is with markets focused on the latest developments in the Iran-Israel conflict as attacks and counter-attacks extended for a 7th day. Oil prices have been volatile, with Brent inching towards $80 per barrel, but still the reaction from the potential geoeconomic effects has not been as dramatic, possibly because of the fundamentals favoring a supply excess and limited chances of an escalation that could lead to disruption of cargo flows through the Strait of Hormuz, which affects about 20% of global supply. The US is reported to be preparing for a possible strike, although a decision has not yet been made. Definitely a space that we are closely watching. Analysts seem to expect a more subtle US intervention that will not go as far as regime change, but will lead to irreversible termination of the nuclear material enrichment processes in Iran. Russia has offered options that will guarantee Israel's security, as it is a major partner involved in Iran's nuclear initiatives, but it is unclear what Russia is positioned to guarantee. The Director General Rafael Grossi of the IAEA, that's the International Atomic Energy Agency, has warned of nuclear contamination risks, advising against bombings which disregard radiological effects and could complicate the geopolitical chaos. Granted that Iran's ability to retaliate immediately has been diminished in the near term, if we do see proxies moving in to support attacks on US facilities, it could get complicated for the US, especially in the intensely divided domestic political climate. The implications will all depend on the scale and length of this crisis, apart from high energy prices, especially hitting energy importers like Europe and India. For Nigeria and many others in Africa, higher crude revenues, yes, for exporters of crude. Pump prices also will go up, and as interest rates stays higher for longer in the US, heavy dollar borrowers will feel the pinch. The result easily being another weight on already lackluster economic growth as inflation finds a fresh driver. And given the tightness of fiscal buffers, this can be coming at a worse time. Still in the US, Trump extended a pause on legislation banning TikTok from operating in the US a third time for a further 90 days to allow time for a deal to split the firm's US business from its Chinese parent company. A fresh executive order instructed that measures should not be taken against TikTok or tech providers such as Google and Apple for allowing the video sharing app to remain on their platforms. And in Nigeria, banks are responding to the central bank directive for banks under forbearance to hold dividend payments until they regularize all provisioning and capital adequacy requirements as independently verified. Zenith Bank PLC, Nigeria's biggest bank by Tier 1 capital, has given the assurance that it will have satisfied all relevant conditions to exit the CBN's regulatory forbearance by June 30. Also adjusting to ensure that maximum credit exposure to a single borrower does not exceed the rules. The bank expects to meet dividend expectations in 2025 financial year. In a similar move, Access Bank earlier said it was also on track to fully meet outstanding regulatory forbearance and pay dividends also by the end of June 2025. The central bank has added in another circular that Nigeria's banking system or banking sector remains fundamentally strong, and latest measures are precautionary and neither unusual nor cause for concern. It is unclear whether independent verifications would have been concluded to the central bank's satisfaction by the end of the month. It's also not unusual for the central bank inspection to have different views on resolution of the issues. Again, another space to watch. As markets seek safe havens, the South African rand fell yesterday to its lowest level in a month, weighed down by risk-off sentiment as the Israel-Iran conflict continued into a seventh day. The cautious mood will play against emerging markets and developing economies' assets as investors prioritize safety. Asia-Pacific markets were mixed as investors nervously monitored tensions between Israel and Iran. Britain, France, and Germany will hold talks with Iran today in Geneva to prevent escalation of its conflict with Israel. China kept its key lending rates steady after a cut in May, also as a trade deal with the US eases growth concerns. Well, that's all we have time for on this special edition of Global Business Insights. Thanks for watching. This is Bode Oshosami.